We are awaiting release of PMI numbers at 9:45 a.m. Eastern Time. Our guest in particular is focused on employment details south of the border. This could be a weak link for the U.S. economy. We're joined by Garnet Anderson, Head of Portfolio Management at Tacita Capital. Thanks for joining us, Garnet.
Thank you for having me.
So just remind you, what are we due to get at 9:45?
Okay, so what we're seeing today is really the PMI services. So Purchasing Managers Index is basically a survey of purchasing managers, either U.S., Canada, or globally. And they really ask the question, is your activity this month greater or lower than the last month? And so if you get a read above 50, it means business is growing. The higher above 50, the more you get acceleration. And so, for example, if you take a look at Canada, it's got its services coming out. So
at 9:45?
Yes, this morning. And so when you take a look at last month, so November's was reported in December's, basically fell off a cliff, went above 50 to down to about 46.
In Canada?
In Canada.
Sorry, is this services or manufacturing?
This was services in Canada, which was a little bit surprised because services has been holding up for the last little bit, but we saw that come off. We saw some job losses, like news that came out of there. We saw that work backlogs were being chewed through. Now, when you put that over to the global picture, where Canada ranks towards the bottom of the table in terms of our, our activity levels, it's a little bit of a more buoyant picture. And so what you've seen is outputs continue to grow. Backlogs, though, have started to come in a little bit. But to chew into that, there has been some buoyancy recently after a pause in terms of some employments. People are looking forward to 2026 and going, we're thinking 2026 is going to be a calmer year than 2025. And they start to hire up a little bit in November. So it'll be interesting to see if that continues in December.
So just to clarify, at 9:45, drum roll, we're going to get numbers on the Canadian services.
And global services.
Okay, but not U.S. manufacturing.
Correct.
I got that mixed up, and I'm sorry about that.
Oh, no. Okay.
Okay, and just to turn to the U.S. economy briefly, U.S. employment is on your radar here.
It is. Well, first of all, there was the shutdown, which messed up the numbers. And so we're a little bit of a catch-up, trying to get a trend. I think every time somebody looks at, the continuing claims or the new jobless claims and whatever, and you look at a single point in time, it doesn't tell much of a story. It's easy to get alarmist about that. You're really looking for trends. So that pause in U.S. data hurt some of that trend watching. So what we're seeing now is when new numbers come out, that's going to help us, see what that picture is. So the PMI numbers are a month-by-month read on that. They see through it because it's, again, surveys of actual businesses. And so stateside, you're seeing a little bit improvement in the employment picture, not to where it was. Whereas in Canada, we're seeing it head a little bit the other way.
You have some stock ideas for us. Start off with American Tower. They are obviously an infrastructure player.
Well, they are, and they're a little bit of a nice diversified plane for some of you who's got a good Canadian portfolio of REITs and infrastructure stocks. We don't really have a single purpose tower REIT or company here in Canada, and they are a world leader. I mean, the major world leader is over in China, just thousands, but they are the world leader on the independent front. They basically have cell towers, which when you think of cell data usage, it just continues to go up and up. We went from 3G to 4G to 5G. That increases usage. Then you think of all the wearables, from watches to eyeglasses and what have you. That drives it up. As we move more towards robotics, well, those movements are all drive data. Cars, to your earlier point.
Yeah.
When we get there one day, well, that's going to drive a lot of data. And so what American Towers has done is they've got the cell towers, and they moved from 4 or 5. They're getting ready to move to 6G. That's still a couple of years out. But they also went in 2021 and bought really kind of a data center business. It's not a hyperscaler. It will link in with the hyperscalers. But if you are operating a robot, for example, you can't necessarily have your data centers making decisions out in Seattle if you're in New York or up in North Bay or what have you, right? So there's a tendency to have those intermediate players closer to where the activity is. And they have 150,000 towers, lots of real estate where they can be.
150,000, yeah.
Oh, it's massive. Well, if you think of on top of all the buildings and the unique sites and whatever, there's a lot. So as they're able to move these little modular data centers closer to those their towers and utilize their real estate better, they're going to get operating efficiencies. So that's been a higher area of growth. The actual cell towers growth has kind of calmed down a little bit. They had some upset. They sold their business in India. Some of the large U.S., because they were really carrier agnostic, but some of the carriers stateside have pulled back a little bit on their sheer growth and popping out new towers. But long term, the data use is going to be there. So we're constructive on the stock. It's a nice, again, diversifier in a portfolio kind of counterbalances some of the Canadian.
Speaking of wearables, I did just get a smartwatch.
It's a good-looking smartwatch.
Nothing very fancy, but it's already informed me that I'm overweight. And it's been telling me, get off the couch, walk around a bit.
It is just after the holidays. That's a fair call.
Yeah, that's incredible. It's actually incredible, the amount of technology in there. We're tight for time. Aritzia, we're getting their numbers this week. You see upside.
Well, we see upside. I mean, it's really a 6-cylinder car driving a 7-cylinder. They're doing pretty well everything right, from fashion to inventory, to their margins, to their step out of their U.S. stores, to step out of their mobile app. It certainly is a good stock. It's a good company, and it's a good stock. It's got reasonable upside. Analysts are all over this and pushing it higher. Just a word of measurement, if you will, sort of thing. It still is a fashion story, and they happen in the right place. But we could just as well have been talking about Lululemon 4 years ago. Right. Everybody's well aware of fashion can come and go. They seem to be executing very, very well. But it does speak to not having it in your portfolio. We've got it in our portfolio from a momentum perspective. It's just a matter of needing to keep your eyes on it. You can't kind of just buy it and park it for 10 years. But again, management's doing a fantastic job. Expectations for their earnings coming up after Thursday's close are expected to surprise again on the upside, which if happens like last time, you'll see a nice little pop in the stock.
Thanks very much, Garnet. Garnet Anderson of Tacita Capital.